Welcome to today's trading strategy review. And today we're going to cover how to trade the 111, the OG, as I call it, the original gangster trade that I came up with back in 2020. So we use this trade quite a bit. It was derived from a few other trade types that we put on. But long story short, this was really kind of the foundation, really turned some of my trading around about 3 years or so ago. It's derived from a trade we were doing called the bear trap and a few other types of trades, all very similar in structure. But I'm going to cover this trade. I'm going to cover pretty much the original way of trading it. I've evolved it into the 112 trade, and then I've evolved that into multiple different types of uses for the 112. So we're going to do a separate training on the 112 and then its different iterations, because there's a lot of different ways to use that depending on what you're trying to get out of the market. But for today, we're going to focus on the 111 trade. And I'm going to go back in time a bit, and I'm going to jump into the original 111 trading strategy that I had put together. This was an updated training from 2022. So a little about a year and a half ago when I had put this together. I updated a few things in there today, but I'm going to leave it the same as a whole, so you can get a sense of what the 111 strategy is and how it works. And then we'll do some examples. And if we get the market open here shortly, we'll put on a trade, or at least take a look at what a trade looks like on it. All right, so the 111 strategy, and essentially what is the 111? Well, it's a systematic way of generating income by selling a combination of put options and using the premium that we collect on those put options. It's either an income source, or you can use it as partially a hedging tool. For me, it's an income source. And we start off by buying an out-of-the-money put spread, so a put debit spread on any underlying that we're choosing here. And then we're going to also sell a put farther out of the money, sufficiently high enough, though, to pay for that spread plus giving us an extra credit for it. So the goal of this strategy is to collect premium, coupled with some ways to make even more money if we have a small 5-10% sell-off or so in the market. So it's kind of a semi-hedge that generates income. Again, no true hedge generates income, but this simulates it pretty well. And if the market falls even further, it gives you a great way to be able to purchase the underlying for a steep discount while making money at the same time. So let's take a look at why we use it. There's simple mechanical trades with a specific set of rules. If you know me, I trade by very mechanical rules. I very rarely am going to just wing something. So they're often opened and loosely monitored, very easy to manage. I don't like to spend 8 hours a day sitting in front of a screen trying to learn or monitor or adjust. Whatever. I like to put stuff on, check in on it periodically, day to day, and take them off mechanically. You can put these on at any time, up, down, what have you. No complex technical analysis is needed. You don't really need to be looking at a chart to figure it out. You can scale these easily for different account sizes. You can use a lot of different underlyings as well, depending on your account size. They've got extremely high win rates. They offer no risk to the upside, which right now in the markets here today, which is June 13th, 23, after the CPI is announced and the markets continue to just go bananas to the upside. But there's no risk to the upside of these trades. If the underlying does move lower, depending on the pace and how low it goes, 5 to 10% drop can pay even more credit. Got multiple ways to win, multiple ways to exit. And you often, again, have that 6 to 10% downside cushion. So really great trade setup. Just touching on some of the Greeks briefly. Starts off with slight positive delta when we put this trade on. As the underlying increases in value, that put price is going to decrease. It's going to be good for us. We're going to get that decrease in price. So from a delta standpoint, it starts off as a slightly positive delta trade. So if the market moving up, It's all good for us. If the market moves up a bunch, it can actually start to take on some negative delta, which is also good. The theta on this, it starts with positive theta. It is really a positive theta trade. And as that time value decays, that price is going to decrease on those puts, which is going to be great for us. Vega, how it is affected by Vega. If implied volatility increases significantly, it's going to increase those put prices, which is not going to help our position here a lot at all. So we want to make sure we're aware of that. And then gamma, if the underlying price increases, that delta is going to fall quicker, which is good. But as that price decreases, that delta can increase quickly, which could be bad. So I know a little confusing on that, but from a Greek standpoint, it's a pretty good setup on the Greeks. So let's talk about the strategy, and then we'll get a little deeper into how we put these on as well. But in this trade, as we're going through these, we start by purchasing an out-of-the-money put spread on the underlying. We're then going to finance that put spread by selling another put farther out of the money, but with enough credit to give us a positive credit overall for the trade. The goal for me is to generate income, but also reduces my risk. If we do pull back, I actually make even more money. So it's better than selling a put or selling a put spread, in my opinion, because if the market does sell off, okay, we could actually make more than our initial credit. So we'll talk about that. You can use it on multiple underlyings. I prefer SPX, SPY, ES futures, MES futures, QQQ, but you can do these on any other underlyings of sufficient size: Amazon, Tesla, Microsoft, Google, other futures. They work really, really well in there. And the trade makes profit in two ways. You've got a tail credit, or tail, which is the credit you received. So there's a tail to these, and then there's a trap that we create where the max profit can occur, which is the width of the debit spread plus the credit you received. We're going to cover that in just a moment or so, but you'll get a chance to see what that looks like. So two different ways of making profit. The tail, you keep your credit. The trap, you get not only keep your credit, but you get also the benefit of adding the width of the debit spread in credit as well. So you really can profit 4 times or more your initial credit. Trade risk and sizing on these, again, for me, never risk more than 2% of your portfolio value on any one trade. So if these do go wrong, if you size appropriately, you take a loss, 2% of your trade, of your portfolio value. It's all good. I don't mind that sizing. Don't allocate more than 30% of your total portfolio to this strategy or any strategy. That's one of my trade rules. If you read my trade plan, you'll certainly know that this is how I trade. And if you haven't read the trade plan, go ahead and take a look at that, and it'll give you a sense of my sizing for strategies and my sizing for max losses. Max loss on this strategy can obviously, if this underlying goes to 0, that's a pretty extreme case. We're going to set stop losses and get out if it's going against us. Also understand that you can be assigned the shares of the far out of the money short puts, and that you would need to cover the cost of those. So there's some risk to you if the market drops significantly to that or past that out of the money short puts. Okay, then you can run the risk of assignment. Typically, we're out before that, but for me, I don't really mind that as much because I'm getting to underlying at probably a 10% discount or so, and it's one great way to purchase the shares. Once you're assigned those shares, you own that underlying. If it drops in price, you can take a loss if you have to sell it, or you can wheel that and wheel your way out of it. And then understand, again, if you're assigned, if the stop drops in price and if you're running covered calls below your assigned, you can lock in a loss, which is why I don't do that from a wheeling standpoint. So let's take a look at trade entry, how we choose the days to expiration on these. I typically look to go out between 45 and 60 DTE. Back in 2020 and 2021, my focus was mainly on 45 DTE. I've lengthened out on these a bit more to 60 DTE. I find you get good credit and a little bit farther away, so a little bit safer, a little bit better credit, and the ROI is essentially the same. And the farther out you go, the more you remove those effects of gamma. So again, 60 DTE, probably preferable to me now, but the original version of this, 45 DTE, which still works really well. And the farther out of the money you can go, but the more negative effect a quick sell-off can have on the trade. We're going to take a look at that as we go. So days to expiration, I'm looking at a 45 DTE. How do I choose the strikes? It really varies. If you're trading like an SPX or an ES, something along those lines where the stock price is a lot higher, I'm probably looking for close to a 50 wide in those, taking in about $10 debit. If it's a smaller underlying like SPY, which is 1/10 the size, I'm going to go about 5 wide for $1 debit. So that's how I put on that put debit spread. For the far out of the money put, in those larger underlyings, I'm trying to take in about a $20 credit on that option. And then for the smaller underlying, if you're trading, SPY, I'm trying to take in about $2. So I'm trying to take in twice as much money on the naked put as I did pay for the put debit spread. That's where our income comes from on this particular trade. All right, some profit exit targets on these. The 1-1-1 setup gives us 4 different ways to exit. 3 of those are ways to win. There's actually probably a few more if you really want to jump into that. But number 1, the loss. A stop loss on this trade would be 1x the max profit. We're going to show that in an example in just a minute. Unless you're willing to accept assignment, then you can let that go, take assignment, wheel your way out of it. That's how we would lose. Winning wise, we have multiple ways to win. You can exit for max profit if it falls in the trap at or near expiration, and it does take all the way up till expiration for you to really maximize that trap profit if you're in there. You got to wait for the full decay on that, but that's one way to win. Another way to win is for it to expire in the tail, or you can exit in the tail for less, if the delta is around 10 or less of the short strikes, we'll cover that as well too, which gives you only about a 5 or 10% chance of it actually getting down into the trap piece. So these are key things for you to remember as we take a look into it. And then lastly here, you can exit for more than tail profit if the profit curve allows, meaning it's getting close to the trap, but it may not be in it, but you're getting close to expiration and you don't want to risk it moving back into the tail and giving up some of that trap profit. You can close it early. There's some other strategies involved. I'm going to keep it really simple here for you on the profit and loss. So is it worth it to wait and just take the tail profit only and not get into the trap? So many of our trades on either these bear traps or 1-1-1 trades expire in the tail. So why not just do a naked put instead? Well, here's a little bit of reasoning as to why I don't do that. Let's take ES. We're going to use ES futures to trade the 1-1-1. And the market's open for the day. So we might buy, let's use an example, the 4,300, 4,250 debit spread. Let's say that's $10. And we're going to finance that with the 4110 put for $20. So we're going to take in a total credit of $10. So the tail profit, meaning the top part or expiring worthless, is going to be $500. The reason being for that is that we took in a total credit of $10. ES has a multiplier of 50. So we're going to have that tail profit of $500. If it falls into the trap, we keep not only the 500, but we get the full trap size, which is 50 wide times the 50 multipliers. 200 is $2,500. So 2,500 plus the 500 we took in gives you $3,000 in the trap. The buying power for this trade is 6,400. So if you end up in the tail, it's still an 8% profit in 45 DTE, which meets my criteria of needing at least 3% a month in return to put on a trade. Why not just sell naked puts? Well, if you sold a naked put at, let's say, 41.10, the max profit would be $1,000 on a BP of 7,000 or 14%. Okay, so a 14% return on that naked put is all good. Nothing wrong with that. But your buying power is higher. I've used at least 10% less buying power, and I have a downside hedge that could pay me up to $3,000 or 3 times, that naked puts expiration, if it expires. So normally too on naked puts, I'm probably closing at 50%. But just for example, on purposes here, let's say you got the full 1,000, but if it drops, okay, you still might expire, but I could make up to 3,000 versus 1,000, spending a little less on BP and being pretty comfortable in the trade. All right, so let's take a look now, if we can, and check out exactly what it would look like to put this particular trade on. So I'm going to jump into the Tasty Trade platform here. I'm going to sail on out to about 45 DTE, and we're going to look to put this trade on here. And I think we talked about doing something around the 4,300, 4,350 for 10 bucks. Obviously, with the market opening up a bit this morning, that's off a tad. So we'll adjust the strikes, and let's just say we land on this 42.60, 43.10. It's a 50 wide for almost $10. Okay. Then I'm going to go out and find a put around $20 here, and I'm going to sell that put as well. So now I have the 1-1-1 structure. Buy one, 43.10, sell one, 42.60, making a put debit spread, financing it with one more naked put at 41.50 for $20. I'm taking in $10.75 roughly for this particular trade. Let's look at what this is going to look like here. So let's take a look at how this trade shapes up. Right, so here's the shape of this particular trade. So as you can see here, if we sold it for 10.75 credit, if we expire in the tail, which is this part up in the top here, this is the tail, the small thin part, that's the tail. If you expire anywhere in here, we're going to keep right now $538 because again, we're on ES 50 multiplier on $10.50 trade. Let's just move this down to 10 bucks, make it easy. So if we sold this for $10 credit in the tail here, okay, we'd keep the 500. If it drops down here into our trap, okay, if we drop into the trap, now our max profit in the trap is $3,000. So that's what we're looking at in the trap. That's also our max loss. So our max loss on this trade is $3,000. How can we get there? We can get there by this price moving quickly down here and sloping down so that you can see exactly, let's leave the let's see if we can get the curve on, and maybe we can walk this thing out a bit. Let's just see. As this thing moves and you start to realize this after several days, if the price hasn't moved, great. But if the price does move, okay, as the price moves, it's kind of a little bit hard to see, I think, here. Let me shrink this a tad so you can see how the curve is working on here. But if price is rapidly dropping on this thing, heading down, you can see profit-wise, curve-wise, we're going to be a lot more negative on this piece. So not really a great example, but if we drop down into here, that will be our this is even better. Let's look at the P&L theoretical, and I'm going to go back to today. on the theoretical P&L, if we drop quickly, you can see how the P&L would be dropping as price drops. As soon as this is equal to the max profit, we're out of this particular trade. We'll stop out. So tail up top, trap back in here, big fat trap. And then down here, the only time we're going to lose or get a sign is if we pass this point of no return down here somewhere around what, 4,100 or so. So 4,100 from here is a 300-point drop, which is pretty close to 8% or so. So 300 points down on right now we're at 4,400 on the market. So 7% drop in the market. So we'd have to drop 7% for us to really worry about getting assigned or having to really deal with something here. If we slowly eke down as time decays, okay, we're going to start to see this trap appear, and we're going to end up in a trap, which is exactly what we want. Okay, so this is how we construct it. You can pick almost any underlying and put these on. They don't make sense in every underlying. You've got to have at least enough price value to do that. If I was doing the same type of trade in SPY, which is what I did a lot of back in 2020, 2021, we'll keep using 45 DTE, and we would do about a 5 wide for about $1 or so, and then we would go out and find something around $2, okay, and put this particular trade on. Here's what we would be looking at if we were doing this in SPY. Okay, so in SPY, a little different. Okay, same exact shape, just a different profit target. Now, SPY, not as good of a buying power, move on this particular thing, but if you like SPY and don't mind owning it at a 7-8% discount, again, this is one way to make money on this, depending on your account margin. If you're on a PM account as well, it could be pretty nice. But this is almost a 2% return on your buying power in 45 days, a little over 1.5. So, not a fantastic return, but if you like SPY and you're expecting us to maybe drop and you want to stay up in here, you can certainly do that on this trade. Again, it's an income trade, and you can do these on SPY, but obviously doing them on futures is what gives us the real kick and the bang for our buck on those. All right, so let's wrap up with a few last things on this as we talk about the optimal 111. The way I really found it best to be trading this was I like to go about 25 to 30 wide for around $6 and then sell the farther out of the money put for around 11. Gets me farther out, okay, and gives me a wider trap. Still good ROI on this. And again, I did not have a single losing trade in 2020 or 2021 on these. 2022, I moved to 112 trade. But all through 2020, 2021, this trade did not have a single loser, and I put on 4 or so to 5 of these every single month. And if we look at this other way of playing it the optimal way, from what I experienced on these, if I was going to go closer to probably 60 days, I was talking about 30 wide. So let's take a look at what 30 wide would look like for around $6. Stay right around here. So yeah, right now, if we put this on today, the 42.80, 43.10, I got about 30 wide, right, for $6. And I'm going to go find an $11 naked put right out here, about 38.75, something in that realm. So $6, 11. Okay, so that gives me about a $5 overall credit for this particular trade. When you look at this particular trade, and I hate how Tasty does their analysis tab. Got to always remove everything else. Okay, you can see that the trap now is way longer. Before we were close to about 4,000 on 4,100. Okay, we now got all the way out to 3,800. So you've got a lot bigger trap for this trade. I'm going to take in $245 on this particular trade. Let's just use 5 as a nice even number. If we were getting $5 credit, I'd make $250 on this trade. Okay, on 39.78 in margin. So this is a 6% trade up here in the tail. Okay, and if you go down in here, you're going to more than 6 times your money in this trap. So if you like this type of trade, this is how I like to set these up a little bit more these days. I've moved to the 112, which is a better trade in my opinion. However, this 111 still works really, really, really well. Lots of different options for these. If the market really sails higher, you could also sell a naked call for a similar amount that you sold this naked put for, and you can make it a strangle with a trap, bulk up your tail profit as well on that piece. So all kinds of things that you can do depending on how the market's moving around. You could also take off this naked put at like a 90-95% winner and leave the put debit spread running. Okay, so if you did that, okay, you'd now end up with a nice put debit spread. So if the market's starting, moving higher, I can leave this put debit spread on. I've already made money. It's essentially a free debit spread. If the market sails down, I've got a free hedge running. That's another way of managing this. There's several other things that you can do on these particular trades, but good trade. One of my favorites, worked great for several years. I've evolved it a little bit more, but it's still the OG trade. I still love doing this trade out there. And the bottom line here on 111 trades is it's a fantastic way to generate that consistent monthly income. 6% every 60 days, pretty good. 3% a month, 36% a year, perfect for me, right where I want to be. Easy to set up, very few adjustments, gives you a little bit of a hedge if the market moves down 5 to 10%, allows you to hedge while you're collecting income there. You can stack these for continuous income, put one on every week. There's all kinds of ways to play with these on multiple underlyings, adjust the widths, adjust the contracts, make it fit your style. It's also a great way to buy stock at a discount. If you want to do these on any other underlyings, you certainly can. Gives you a really great opportunity to do these. I don't know. I have not looked recently at what it would look like on like Tesla or something like that, but let's take a quick look at Tesla and let's see what it would look like to trade something like this on Tesla. Obviously, I'm going to go a lot thinner, but let's say I did this 5 wide on Tesla and I want to sell, put out here. So here's what this would look like on Tesla. Now, I'm not saying this is the optimal trade setup, but here's what you're looking like on Tesla. So if you think Tesla's moving higher, but you want to hedge yourself a bit, I could sell the 210, 205 put debit spread for about $1 and then buy the 180 or sell the 180 put for around $2, giving me a nice little credit here. You've got hefty buying power on Tesla here, but it's a $130 winner on 5,300 roughly in margin. This is a 2.5% return in 60 days on Tesla. Now, you can make a lot more if you had bought Tesla, but what if Tesla starts to drop from here? Is Tesla overbought? It's up another $4 today. I think it's up 13 straight days in a row, which is bananas. Okay, so at this point, if Tesla you feel is getting pretty overextended, you could leave this on, take in 2% on your money, which is not bad, or a little bit more than that, I think. But if Tesla drops down into here, okay, you could buy Tesla at 180, which you wouldn't mind doing potentially here. Also, if it drops, you have this trap in here. So you can look at these on different underlyings, play with them, play with your different strikes. If maybe I make the strikes wider and take in no credit for more of a hedge, maybe I make the strikes, I don't know if I can make them really narrower, but I can move the naked put up a bit, make it a little bit more of an income trade on it. I can move this put debit spread higher on it. If I move that put debit spread higher, I'm taking in a little bit more credit, and I'm giving myself, depending on where we are here, I could take in similar credit, give myself a fatter trap, and a quicker way to get into the trap as well. So there's a lot of different ways to play this particular trade as you move these strikes around. You get more income, less income, you get a bigger trap, a smaller trap, whatever you really want to achieve. You can make it a really small trap, okay, but still a trap nonetheless, take in more credit, and now I've got, $184 winner on 5,900. So now I'm a little bit over 3% return on this trade. Maybe it makes sense in certain accounts to want to do that. It would not probably be something I would put on. Doesn't hit my criteria. You could also do these trades in other futures. So futures is where I really make my play, make my stand. If I wanted to do this on oil right now, I could put this thing on somewhere around, let's just, these are pretty high, pretty interesting. So let's say I want to put an oil version of this on, and I want to get some safety out here around $60. Here's what I'm looking at in oil on a 1-1-1. Again, I prefer the 1-1-2, but here's the 1-1-1 trade in oil. So oil's been up and down, more down lately than anything else. So oil's been on a pretty good selling kick, and might be finding some support in here. But if you think oil could go lower into the 60s or all the way down to the upper 50s, 60 mark here, man, look at this opportunity. So if we end up in the tail up here, okay, $350 winner potentially on this trade. Okay, so I'm at a $350 winner since I'm taking in 36 cents, 35 cents, 37 cents, something along those lines with the $1,000 multiplier that's on oil. But let's say I take in $360 in credit on 4,700 in margin. Okay, that's an 8% tail in 65 days. So I can make 8% if oil stays here or moves higher. I make 8% in 65 days. If oil drops, 10%, which would put us right around 63, would put us dead in the middle of this trap. If oil drops another 10, 12%, 5%, I'm in this trap, and now I'm making $2,350 on 4,700. So I'm making almost a 50% return on my money. So take a look at the different strikes, take a look at the different options, take a look at the different plays that you have. But bottom line, the 1-1-1's a fantastic trade. It's my original trade that I really pushed and played hard with, and kind of made popular with a lot of different groups out there, 2-3 years ago. Have evolved it from there, but it's still a great trade. You can still make really great money with this particular trade. If you like this video and you like these strategies, click the like button. Go ahead and subscribe too. I'm going to be posting a lot more strategies. I hope you like this trade. If you have any questions, drop them in comments on YouTube here, and we'll see you guys in the next video. Take care, everybody.